Okay, so we're exactly in time to start. The second session. We have a short 60 minutes, and we have three excellent speakers. So this topic was called Comments from the Central Bankers, but comments from the central bankers on the central bankers or on central banking in general. And I think the three speakers have decided to talk about central banking in general, because if you look at think of the subtexts of what we've heard earlier on, you can tell what central banks worry about and the subliminal and the deeper thoughts that central banks had. And if there were three things that I would pick out that central banks are thinking about and worrying about these days, I would say, first of all, they're wondering and worrying about the mandate. Central banks are often portrayed, at least in economics textbooks, as inflation nutters, and they're only interested in getting inflation exactly or close to but below than 2%. But do they have a broader mandate, and how wide should that mandate be? What should central banks try to do, and what should they not try to do? And that was running through a little bit of what we heard, particularly from Pat Harker this morning. So that's the first issue, mandates. What should central banks do, and what should they not do? Then, when it does come to inflation, when it comes to monetary policy, when it comes to managing the macroeconomy, getting demand level and pattern of demand right, what instruments should be used? And the challenges, particularly now in this environment of low interest rates, low inflation, should interest rates be increased or lowered at this juncture? Of course, depends on where you are, but also depends on your perception about the instruments that are available, say in countries like Japan, to get back to where they want to be, which is also 2% inflation, but they've been way under it for a long, long time. So that's the second issue, is instruments of monetary policy in this low inflation, low interest rate environment. And the third topic is trying to make sure there isn't another big financial stability meltdown again, so macroprudential policy. I think those are the three things that central bankers worry about. And our three speakers today, I think, are going to take aspects of those three topics. You've got their bios in your folder, in the paper, so I won't introduce them at length. Three excellent, experienced central banking academic, quasi-academic economists. We'll start with David Altig from the Atlanta Fed. He's the head of research, EVP there, and I was just looking at his list of an enviable list of publications and all the top journals that they are. So I'm too old to start that again. We start with him. We will move on. I've forgotten which order. I decided to do it. I'll get this wrong now, but I think we move on then. Secondly, to it's a question of order, not necessarily this order. What did we say? I think you're second. Alan Ahern, who's actually careful here, because Alan is a member of Central Bank Commission. So there was discussion there earlier about what do the local commissions and boards, the regional Federal Reserve banks and the national central banks, what do they do? And Alan is one of those. He's also the head of economics in NUI Galway. He's also, in his dim distant past, an American central banker, board of governors. And then finally, Anthony Murphy from the Dallas Fed, but well known to us here in Dublin, and also well known in Oxford from previous parts of his career. And I think he's going to talk to us a bit on the macroprudential side. So it's good to see Anthony back here. Start with David.
Are we up? Or am I'm supposed to do something? Yeah, great. That's just right to it. So it's a great pleasure to be here. I am going to speak to this topic of the choices that central bankers make. I am not going to talk about choices like interest rates or asset purchases or any of those sorts of things. basically operational aspects of policy. I'm going to speak to this broader issue of the mandate, what the choices are that we make related to our mandates as central bankers. I'm going to start the conversation in kind of a mode befitting a research director as a modeling choice. But models are really sort of just the stories that we tell, and the stories that we tell are representative of the things that we think ought to be left in our orbit of influence, and those things that ought to be left out. So I will morph this into the bigger philosophical question and practical question, for that matter, of what should we actually be aiming to do in the world that's presenting us these days. So with great fanfare, earlier this summer, the St. Louis Fed, President Bullard, made a pronouncement about his decision to adopt a new framework for monetary policy making. So if you follow this, you know that he basically said, by the way, the views that I express are not necessarily those. But there's his words, and his words were, look, I've kind of given up this long-term forecasting exercise. It doesn't make any sense to me anymore. I think the world is much different than the way I've been modeling it kind of my entire life as an economist. And here's the way. So usually we think of there's some shock to the world, and then the world emerges back to some normal that existed that doesn't change very much over time. I don't think that's the way it works anymore, says President Bullard. He says the way I think it works is you kind of have these different regimes, and you get stuck in them, and you're in them for some while, and then you kind of flip out of them. And the regime that we're in now, and that's why you can't forecast it, because at any time, a bolt of lightning is going to strike, and you're going to find yourself in a different regime. And maybe it's a good one, maybe it's a bad one. It is whatever it is. Monetary policy's got nothing to do with it. You're just the world that is presented to you. And the world that's presented us now is this sort of low productivity, as far as the eye can see, situation. And in fact, President Bullard has publicly said we're pretty close to normal now. Now here's the thing about that framework. That framework essentially takes productivity as outside of the influence of central banks. So God or Satan or whoever it is delivers some productivity to you, and that's it. Is that it? Is sort of the relevant question here. So here's the picture he's looking at. This is U.S. labor productivity. And I've given you some reference points there. That purple dashed line is the 20-year trend in labor productivity in the United States. The orange line is the 10-year trend. The green line is the last 5 years. And you can see where we're tracking. And so if you're not an economist, the technical word for that is bad. Stinky, if you would like. Productivity growth is stuck at about 0.5%. I mean, and historically, this is just awful. And the thing is, we think we know something about why that picture looks the way it is, and it has to do with this picture. And this is just a picture of business fixed investment. This came up earlier today, and will come up a lot more. Business fixed investment in the United States. So the way this picture is constructed is the level of business fixed investment is normalized to 100 at the beginning of the Great Recession, so at the end of 2007, and then we're just tracing it quarter by quarter through time. So you can see the effect of the recession, and you can see the recovery of investment up to the second quarter of this year, and that is a very shallow path, and if you look hard, you can even see it kind of trailing negative there at the end. So to give you some sense of how bad that is, here's every other business cycle since 1960 in the United States. This is just an unprecedented in its badness. at least in the post-war period. And it has been pointed out, this picture is not unique to the United States. Basically, pick any advanced economy in the world, and you see a picture very much like this. And this is the smoking gun to that productivity picture. So here is a chart from John Fernald, actually, at the Federal Reserve Bank of San Francisco. So let me kind of walk you through this picture. First, just focus on the height of each of these bars. Each of these bars, the height is just the growth rate of labor productivity over different periods of time. So the very first bar is associated with the great post-war boom up to about 1973. The second one is then the great productivity bust in the United States from 73 to about the mid-90s. The second one is the great productivity boom associated with the tech revolution in the late 90s. Then you see right before the crisis, during the crisis, where productivity picked up because employment fell so much faster than output fell. And then you see the last 5 years at the end there. And you can see that that's much lower than any of those other bars. But the really interesting part of this picture is the colors. So the colors are about decomposing productivity growth in each of these eras into different sources. So the blue is just sort of the act of God, total factor productivity, just kind of general advance of know-how. The orange is the labor quality bit, which President Harker referred to. And the green is the contribution of capital deepening or investment. And the one thing that screams at you in this picture is that the real distinction between this and any other of these periods after World War II in the United States is the fact that investment is not enough to keep up with the growth of the labor force, and in fact, the contribution of capital deepening is negative. Now, this doesn't actually contradict the earlier comments of President Harker about the importance of labor quality and labor skill. John Fernald has actually also forecasted these bars forward, and one of the things that will happen is the bars look pretty bad going forward as well, in part because the orange area here, the labor quality part, is anticipated that it is going to actually shrink in its contribution. So we're going to have the double whammy if investment does not improve, of declining contributions of labor quality, which includes skills, educational growth and educational attainment in particular, and this terrible capital deepening picture. Now, how do I connect this up to what I said I was going to talk about to begin with? Well, remember the kind of St. Louis framework. The St. Louis framework is the productivity outcomes are exogenous to the central bank, to monetary policy. Monetary policy does not affect these things. There's some act of some deity that delivers us some productivity growth. In this case, the deity is a particularly nasty individual and has given us terrible productivity, but that's the world we live in. Now, if investment is a large part of that picture, however, isn't that clearly something within the control of the central bank? Do we not, as monetary policy makers, think that somehow the things we do influence the pace of capital accumulation? So my first instinct when I saw new St. Louis model is, man, this seems like a step backwards. This seems like something that is taking off the table in the monetary policy discussion something that ought to very definitely be on the table. That we ought to, as monetary policy makers, take some responsibility for this picture. That was my first instinct. My second instinct is, I'm not so sure. There was a conversation also this morning on anecdotal, the importance of anecdotal information in making monetary policy decisions and in the the activities of the Federal Reserve banks in particular. We've shown this picture to our directors and our business contacts and everybody we can get in front of all the time and say, please tell us what the heck is going on. And the thing that comes up over and over and over again is uncertainty. And that uncertainty, you can start with the Greek debt crisis and go to the debt ceiling showdown in the United States and on into the Chinese meltdown in their equity markets, to Brexit, to the election, all things that actually do not seem to have very much to do with monetary policy. And in fact, we think we know quite a bit these days from a burgeoning kind of body of research about the effects of investment on the economy, which operate primarily through investment. Now, this is an old literature. It started actually in its modern guise with Ben Bernanke, who basically said, there's option value to waiting on investment expenditure when there's a lot of heightened uncertainty. Now, the thing about that model, about that kind of story, is that, well, uncertainty comes along. You would expect a decline in investment, but you would also expect some bounce back when the uncertainty lifts. So you get over Brexit, you find out, that wasn't quite as bad as we thought. And you ought to see an investment overshoot, something that approaches a boom to match the bust that you saw before. Haven't seen that. Now you might argue, I just gave you a big long list of uncertainty events. So maybe we just never get to the bounce back period, because every time we turn around, there's another lightning bolt hitting us. That's maybe a story, and that would be a hopeful story, because if things settle down, eventually this all resolves itself. There is a more recent literature, however, that says that story is not so much maybe right. That in fact, particularly in an environment where financial market activity is impeded in some way, there are frictions, and you could argue that changing regulatory environments have certainly created such frictions, that these uncertainty shocks, even if they're temporary, have very long, persistent negative effects. All of which was simply to say, remains, to me, a vital and open question. Should the central banks, should monetary policy take on board basically the St. Louis model? If we thought the central banks were creating uncertainty, that would be one thing, and I'll let you come to your own conclusion on that. But if it's all this other sort of stuff, maybe the St. Louis framework is just exactly the way we ought to be processing the world. If it's not, however, correct, then we are absolving ourselves of responsibility for something we very definitely should be taking responsibility for. This is just one of a number of such existential questions. So here I've listed 3, all of which were at Jackson Hole, like one month ago. All of these things came up at Jackson Hole. So prior to the actual conference proper, there was a meeting that President Harker was at with a lot of his Fed colleagues, including my boss and Governor Fisher and Governor Brainerd, with a group called Fed Up. You may know of Fed Up. They're a bunch of it's a coalition of advocates for lower income minority interests, and basically their argument is the following: you guys, the Fed, you get to you have a mandate for maximum employment. You've defined maximum employment in a way too narrow way. That is, you should be worried not about sort of the average level of unemployment. You should be worried about the distribution of unemployment experience. And in a more sort of technical model-y way, they're sort of saying, look, you should be willing to overshoot on the frontline unemployment rate to bring along those who have, those groups that have unemployment experiences that are not nearly as satisfactory as sort of the average would suggest. And maybe you'll get a little bit more inflation, maybe you won't, but isn't it worth the risk to do something you say you can't do, which is actually alter the distribution of economic outcomes. So whether you're talking about income inequality or labor market inequality, it's the argument that our aggregate measures of success are leaving people behind inappropriately because we have an insufficiently broad notion of what monetary policy can accomplish. And we have that insufficiently broad notion because we're bad modelers. We turned on our, we screwed in the light bulb in graduate school, it burned out, and we're sitting in the dark. The second one was Chris Sims gave a speech on fiscal, it was basically on fiscal theory of the price level. We don't need to go into the nuances of that. You don't even have to buy it. It was just, so Chris's argument is the feasible set of things that you can do as a monetary policymaker is constrained by what fiscal policy in its traditional sense, spending and tax policy, aims at. It's a challenge to think about sort of what degree of coordination is necessary across the government, across monetary policy makers and fiscal policy makers, and what can we do and what should we do, and maybe this sort of act of independence is leading us down some roads that are throwing us into the ditch on occasion. Finally, there was a really nice paper by Duffy and Krishnamurthy, I thought, detailing how financial market regulation, banking regulation, and liquidity coverage ratio, for example, was one that really stressed, is altering the transmission mechanism. That is basically changing the nature of the pass-through from policy rates to other short-term market rates. So it raises the question, how integrated should regulatory policy and monetary policy proper be? There is an approach, I think, that is at least common in the United States, I presume it's actually common here as well, to construct regulatory policy for financial stability purposes, and then optimize monetary policy given the constraints that presents. Maybe that's just completely the wrong way to think about it. That we ought to think of our mandates in an integrated way, and by integrated I mean there's some optimal mix of monetary policy proper and regulatory policy, and they ought to be bundled up into a big ball and then molded into whatever the optimal outcome might be. Something that's quite different than the way we tend to think about things in most central banks. So I think things like these, thinking about what we can accomplish, how we can go about accomplishing those things, whether we ought to think fundamentally differently about our mandates are the big questions now in this existential crisis that we're basically living through. If we define our mandates too expansively, then we will almost surely mess everything up. If we rely only on monetary policy to do things monetary policy can't do, that is obviously a problem. But if, on the other hand, we define our mandates and the possibilities of what we do too narrowly, then we're going to leave parts of our constituencies behind. We'll be insufficiently addressing our mandates. We had a long discussion at dinner last night about credibility of institutions in the world, and that credibility will almost certainly be harmed by leaving things on the table that ought to be on. Thanks so much.
Yeah, that's exactly what I'm going to do. Thanks, Patrick, and thanks to Bill McLaughlin and the GIC for the invitation. Good morning, ladies and gentlemen. Yeah, I thought I might do something completely different to talk a bit about Japan's experience with unconventional monetary policy. It picks up from Sharon Donnelly's part of her speech this morning, which talked about non-standard policy measures in Europe. I thought I'd talk about Japan in part because I'm just very interested in it. When I worked at the Federal Reserve Board, I covered, most of my day was spent covering Japan and their efforts to try to get out of deflation. But also that we're thinking about unconventional monetary policy. The Japanese have been doing it for a long time because they've been mired with very low, either deflation or very low inflation for a long time. So in many ways they've been at the frontier of efforts to try to get inflation up to some target. President Harbour mentioned this morning about the limits to monetary policy. Well, the Japanese have been pushing on those limits for a long time with new innovations and testing those limits in an effort to try to hit their inflation targets. And so I think it's consistent with the theme of this particular session and also of the conference. And we might be able to draw maybe some lessons from the Japanese experience. Probably there aren't any lessons for the United States at this stage of monetary policies. Gradually, accommodation is being withdrawn, and hopefully no lessons are needed for the euro area. But it'd be horrible to think we'd be here in 10 years' time discussing how the euro area, what measures it might take to try to get the inflation back up to target. But who knows? You certainly can't rule that out. I mentioned the Japanese have been doing a lot of stuff over over the last 15 or 20 years or so, and that's captured in my first graph, which is showing you a timeline of monetary policy actions in Japan. That goes all the way back to 1990, following the collapse of the bursting of the asset price bubble. The Bank of Japan cut the interest rate. It was about 8% or so at that stage in the early 90s. And then right through the 90s, particularly the first half of the 90s, cut interest rates down to very low levels. And they introduced ZIRP, or zero interest rates, in 1999. So interest rates got to zero, something we're very familiar with now in major central banks. But they had introduced or pushed the policy rate down to zero in the late 1990s. I started covering them in the early noughties, and at that stage, Japan was struggling with deflation, trying to get out of deflation. Interest rates were at zero; they'd hit the lower bound. So they introduced quantitative easing, where they started buying lots of assets, lots of Japanese government bonds, JGBs, and over the course of the first half of the noughties, they started ratcheting up the amount of these assets that they were buying. Things looked like some sort of recovery going on in around 2006 and 2007. That is one of many false dawns that the Japanese economy has had over the last 20 years. And that's a theme I might come back to a little later. The global financial crisis came, Japan back into deep deflation, and then in 2011 they introduced some new lending schemes and asset purchases again, and then in 2013, it's the yellow area, they introduced QQE, or quantitative and qualitative monetary easing, where they promised to double the monetary base in a short period of time. Large purchases of government bonds. So lots of unconventional monetary policy. The Japanese have been doing lots of different things. Right at the end of that is early 2006. Early this year, they pushed short-term interest rates to negative. And so I mentioned Japanese in many ways have been at the frontier. Here they were about 18 months behind the ECB in introducing negative interest rates. Well, they did introduce negative interest rates on some of their reserves. And what isn't in that graph is the latest policy measures they introduced just last week, and I'll come back and talk about them a little later on. So it's a picture where they've done an awful lot, and there's a rich experience there, and they're continuing to do more in terms of unconventional or non-standard monetary policy. Why are they doing that? Well, they're trying to get inflation up to 2%, and what you see in Japan is a chronic undershooting of inflation. That graph shows you two measures of inflation. If you just focus on their target is 2%. That's for what we might think of as core inflation. Their measure of core inflation excludes fresh food prices, which can be volatile, but does not exclude energy prices. And that's given by that red line. So you can see the zero line in there. You can see the magic, the 2%. That's what they're trying to get. This graph goes back to 2008. And you can see that there are times where the inflation rate has got up to about 2%, but what I've also put in there is the index that excludes food and energy, sometimes called core, but it's a sort of measure that maybe central bankers are more used to. And you can see that, for example, in 2008, although the core had gone up to 2%, it was really all driven by energy. So what they're struggling to do is to get the inflation rate up to 2%. And you can see quite worryingly, in fact, in the last year or so, that inflation inflation performance has deteriorated again, and is now looking at deflation or at least negative annual changes in the inflation rate. Mirroring that, you have if you look at the real economy, the economy is in the doldrums and has been for a long time. So you have an economy that just seems that it's just always one shock away from being pushed back into deflation. They cannot decisively push the inflation rate up to 2%, or they cannot get robust growth going where you think an economy that could therefore be able to withstand negative shocks. As I said, there always seems to be one shock away from going back into being mired in deflation, and those shocks, of course, inevitably come. Sharon Doherty spoke about the transmission channels earlier, how this quantitative easing and these non-standard measures should transmit to the economy. So I just looked at some of the measures from Japan, some of those channels. One, of course, is that they're buying lots of government bonds pushes down the long-term interest rates, and you can see that on the left-hand side as you look, that certainly happened. When I was covering Japan, JGB 10-year money was about 1.5% yield, but that's come down over the last 10 years or so. And in the last, certainly since QQE, it has dipped to about 0%. If you look at the right at the very end, in fact, the 10-year money went negative during the summer. It's back up to about 0 today. So 10-year JGBs are yielding about 0. But certainly the unconventional monetary policy has pushed down interest rates, nominal long-term interest rates, and indeed real long-term interest rates. Similarly, Sharon spoke about working through the banking system, the credit channel, and that sort of stuff. And you can see on the graph on the right-hand side, what I've given you there is a measure of bank lending. That's the solid black line. So you can read it off the left scale. And what you're seeing is there is growth, albeit very moderate growth, in bank lending, and the quantitative easing in the QQE has worked to reduce the interest rates the banks are charging. That's the thinner line. You can read it off the right-hand side. So financial conditions have certainly, there has been some improvement in financial conditions. Non-conventional monetary policy is also supposed to work through the exchange rates, and that's a graph of the yen. And one of the things about in Japan is that every time there appears to be some strengthening of the economy or some good news, the yen gets very strong, and that seems to frustrate a lot of their efforts to try to get the inflation rate and get the up and try to get the economy going. You can see, particularly recently over the past year or so, the yen has strengthened quite substantially, and that's a big worry for the Bank of Japan. That said, the yen is still quite weak relative to what it was, that's in 2011-12, but certainly the movement over the last 12 years is frustrating the Bank of Japan's efforts to try to decisively end deflation. If you think about transition mechanism, maybe one way to think about it is the sort of overall macro picture on overall macroeconomic channel through which this quantitative easing is supposed to work. And that's, if you look on the right-hand side, that schematic there is the Bank of Japan's, it's from the Bank of Japan report about how they would view quantitative easing as working. And what it's for macroeconomists a pretty standard channel, a pretty standard mechanism. That is that the Bank of Japan would have a strong and clear commitment to hit this 2% target. That would feed into people's expectations about where inflation is going. The purchases of government bonds would pull down nominal interest rates. So if you get lower nominal interest rates and higher expected inflation, those two are combining to reduce the real interest rates, and that reduction in real interest rates is supposed to increase aggregate demand and aggregate spending. That then, when people see the economy getting stronger and see a slightly higher inflation, that feeds back into their expectations, and again that causes real interest to fall even further. So you get this virtuous circle going on. So this is what they're trying to do. But there's been a number of problems, and they've experienced a number of side effects that I just want to say a few words about. The first is that there's research from Japan that when people are forming expectations about inflation, that people largely use adaptive expectation. That seems to be a stronger phenomenon in Japan than in any other places. That is that when the businesses and the markets and citizens are trying to think about where inflation is going to go, they look at current inflation rate, and they're very slow to change their expectations about where inflation is. It's making it difficult for the Bank of Japan to shift expectations and to get people to increase it. So adaptive expectations seem to be an important part of the way that Japanese form the forecast for inflation. The other side effect from all this is that they have bought a lot of government bonds and brought down long-term interest rates, and that's caused the yield curve to become very flat. And that's been a worry for the Japanese, and it is in some other areas, about how that's affecting banks and financial institutions' profitability. I mean, during the summer, the short-term interest rates were slightly negative. The 10-year JGB yield was 0. And even if you looked out the 30-year, in the Japanese issue long-term bonds, 30-year and 40-year bonds, the yield on the 30-year bond was practically 0. So you had more or less a completely flat yield curve, and that is something that the Bank of Japan is clearly worried about. If you think about banks' profitability, and that's a graph I found on Bloomberg, it's showing you, of course, what's happening with the flat yield curve is that the lending and deposit rates are being compressed, and so banks' net interest margins are being compressed. That's a graph showing you net interest margins, and what it shows is that Japanese banking system has some of the lowest and narrowest net interest margins. The Bank of Japan put some of that down to lots of competition in the Japanese banking market, but clearly I think some of it has to do with what's gone on with the yield curve. And you know, if you're talking about something that's measures that are going to last a couple of years, and then the banking system may well be able to absorb that sort of pressure on the margins. But what if you're talking about something that's going to last for a couple of decades? Then clearly the bank's business models have to be robust enough to be able to handle that sort of environment where you got pressure from a very flat yield curve. The other thing about that's been an issue for the Bank of Japan is that they've been buying so many government bonds. Some people have begun to worry about whether they'll run out of bonds that they can buy. The Bank of Japan owns about a third of all JGBs, and the pace that they've been buying them, although there's a lot of JGBs out there, that seems to have begun to play into their minds. If they kept on this pace of purchases for a long time, they'd eventually, first they would put some pressure on liquidity in the market, but then they just literally run out of bonds to buy. So I think in part reflecting some of those concerns, what we saw, and the fact that inflation, as I showed you earlier, has dipped down into negative territory again. What we saw last week, the 21st of September meeting, was another some more ammunition fired at this very low inflation. What they did is they committed, they had an inflation target of 2%, but what they announced, and Governor Corona announced on the 21st, was a commitment to overshoot the 2% inflation target for a non-specified time. So not only going to hit inflation, hit 2%, they're going to go beyond it and keep inflation. So you can see that they're trying to shift people's expectations in a way, because they're underperforming on the inflation rate. They're going to try to make up a little bit of of what's happened of the undershooting of the price level, like having inflation run above 2% for a little while. The really interesting thing is that they are going to target not just the short-term interest rates, which is standard, but they're also going to target long-term interest rates. And so what they're calling QQE with yield curve control. They're going to try and shape and try to shape the yield curve. So they're going to keep policy interest rates, the short term, at negative 10 basis points, but they're promised or committed to peg the yield on 10-year Japanese government bonds at around zero, where it is now, for the foreseeable future. And what they're hoping to do is change expectations that would cause maybe the 30 and 40-year yields to rise, that keep the 10 years at zero. So you can see that they'll engineer a bit of steepness or a bit of a slope in the yield curve. That's which would alleviate some of the issues, but also try to bring down the real interest rate, and therefore get the inflation rate back up. Is it going to work? Don't know. It's too early to tell. But I just want to finish with this slide. If it doesn't, where can they go next? I mean, as I said, they've been very innovative in trying lots of things over a long period of time. Well, one possibility, and they've been the central bank to do lots of things first. Maybe they'll be the central bank to do helicopter money first. You see, if you go back to the schematic I showed you, what they're trying to do is, of course, get the real interest rate down. But that works in terms of stimulating the economy only if you get the real interest rate below the so-called equilibrium interest rate. That's where monetary policy becomes stimulative. And the problem for Japan, I think, is that the equilibrium interest rate is very low. It's probably negative, and probably significantly negative. That's because it's linked to things like demographics and productivity growth, and those things are unfavorable in Japan. And as David has talked about, not just Japan, productivity growth is a problem elsewhere. But if you have a significantly negative real interest rate, although you can get an actual negative interest rate, it may not be as stimulative as you think it is. So they've got to get the real interest rate down, but they'd like to get the real equilibrium interest rate up. One way to do that is to try to fix some of these problems of productivity. Extremely difficult to do, the structural reforms, all that sort of stuff. But another way to do it is to boost aggregate demand that raises the equilibrium interest rate. So what they need, it seems to me, is a big boost to aggregate demand to decisively shift people's expectations. And how can they do that? I mean, what's going on, and you can view it as that implicitly the government is, there is monetary financing of government spending, because the Bank of Japan is pegging a long-term interest rate. But that doesn't seem to have resonated. I mean, they talk about, and Economics was based on sort of synergy between monetary policy and the fiscal policy, but maybe it's all just too subtle. And what may be required is a much more explicit monetary financing of expansionary fiscal policy, and we'll see whether that's where they go. Thank you.
So to paraphrase Bertrand Russell, when he went to Russia and we went to Japan, he said, I've seen the future and it works. Maybe we're in this sort of situation here, but we don't Anthony, if you got inflation to 2%, then how would you prevent the next bubble from bursting? You're going to answer that question. European and American context. We're running a little bit behind, but I think the presentations are so interesting that we should not worry too much about that.
Okay, the usual disclaimer applies. The views here are my own views. I'm not allowed to talk about future monetary policy, and the views I express are not those of the Federal Reserve, Bank of Dallas, or the Federal Reserve System. So they're pretty much my views. And I see if I'm competent at going on to the next slide. So we weren't given too many guidelines about what to talk about, so I thought I'd mention some differences between the US and Ireland in terms of central banking. The things we're interested in are pretty similar. We're interested in having some mandate that Dave Altick mentioned. In the case of the US, it's a dual mandate. We're concerned with inflation and we're concerned with employment output or unemployment, whichever way you want to focus about it. So that's different from Europe. In Europe, it's, or in the Eurozone, it's inflation only. And then the other issues, supervising or regulating banks and so on, maintaining financial stability and those sort of issues, they're common, but in the case of Ireland, those are largely determined in Europe or at the ECB and so on. So inevitably the role of the Central Bank of Ireland is more limited. One of the things I think is pretty common is the regulatory landscape is becoming a lot more involved. And that's happened in the US and it's happening in Europe as well. So at one stage I would have said Europe was behind, there weren't as many regulators. Now I think it's catching up. So good for regulators. In terms of monetary policy, we're much closer to normalizing monetary policy, as in we've raised interest rates last December, and then the recent FOMC statement is the case for an increase in the federal funds rate has strengthened. They decided to hold off for the moment. Some people would say this is soon rather than now. And people have criticized that approach. Some people say it should be now as opposed to soon, but this is the judgment of the FOMC. In terms of the risks to the economic outlook, they're roughly balanced. And all of the risks are probably external as opposed to internal domestic risks. So the risks are what happens to global demand, what happens to China, whether Brexit blows up at the end of the year if they invoke the relevant article and so on. So I think the risks to the US outlook they're broadly balanced, but probably will have much more to do with what's happening externally than internally. Or that's my reading of the situation. The ECB is not unlikely to reduce monetary accommodation for quite a while. So we're in a completely different policy environment. And the real thing about the Eurozone is it's nothing close to being an optimal monetary union or currency union. Whereas the US is closer to being an optimal currency union. So a one-size-fits-all monetary policy works much better in the US than it does in Europe. There's no fiscal union in Europe, so if we have adjustment, a lot of the time the adjustments falls on, it's very unevenly distributed and it falls on a small number of states, which is an issue. And then in terms of some of the underlying long-term issues, we need supply-side reforms in Europe, and they've been very, very slow to happen. Whereas labour markets in the US are a lot more flexible than they are in Europe, and part of the reason the US economy has recovered is because the supply side is much more flexible than in Europe. And then obviously in terms of the sort of what shapes things in Ireland, Ireland's a small open economy, so a lot of the developments and the outlook for the Irish economy is based on what happens elsewhere in the world. Okay, the US is exposed to external developments, but net exports, on the whole, they don't contribute too much to GDP. They contribute a little bit. But external developments are probably less important apart from the financial side. So obviously if US interest rates change, there can be effects, but quite often people, I think, they overplay the effects. If the US raises interest rates, well, it tends to be a leader, and other countries will tend to follow along as well. So in my view, some of the effects of raising interest rates, the external effects of raising interest rates, are probably overplayed. Okay, longer term issues in the US, these are issues that have been mentioned already, and the longer term issues are relatively lower output growth. So in the past, if you asked people what was the normal, or you looked at FOMC statements or something like that, what was the normal rate of growth of the US economy? Well, it would have been 2.5% a few years ago, and now the FOMC is coming out with something that's around 2%. If we look at the natural rate of interest, the sort of normal rate of interest that would hold where the economy is close to full employment and inflation is at 2% at target, the FOMC has reduced its estimate of the natural rate of interest. Within 15 months, it's reduced it by over 1.25% or something like that. So there's been big changes in the FOMC's views of what the underlying normal rate of interest. If you're used to thinking of this, this is the constant in the Taylor rule that people talk about. So I'll show you some estimates of this in a minute. So what's going on? We think it's a combination of changing demographics, the factors less capital deepening, and the total factor productivity, the extent, the way capital and labor combine together, the efficiency with which they're combined together, that has gone down. So I don't think it's any one factor, it's a combination of factors. You might argue that some of the extent to which we aren't seeing as much investment is due to the recession, but I think some of these trends have been going on a little longer. Okay, in terms of lower total factor productivity at the macro level, it's mirrored at the micro level as well. So when you look at micro data, you see widening gaps between the most productive and the least productive firms. So the frontier has moved out, but some firms are being left behind. So the economy doesn't appear to be as dynamic as it was in the past, the US economy. In terms of startups, there are fewer, and then there's less real allocation from sectors that are expanding and to sectors that are expanding from sectors that are declining and so on. And then one issue that's a big political issue is the aging demographics and the level of government debt. If you look at any sort of projections of long-term government debt, particularly those produced by the CBO, which is non-partisan, the trend is upward, quite dramatically upward, and it's an issue that has to be dealt with, probably has to be dealt with at some stage, not necessarily in the short run. So in terms of these longer term issues for the US economy, my personal view is that there's a limited role for monetary policy, and there's a limited role for short-term fiscal policy. What monetary policy can do is provide a stable monetary policy and stable financial system. So this is where macroprudential policies come in, but we have to be careful about the trade-offs. People have mentioned liquidity coverage ratios and other policies, macroprudential policies. They're fine, but there are always trade-offs. You may change the function of labor markets, you may make them less efficient. But really we're talking about sensible. The problems, the longer term economic issues in the US, in my view, are supply side, to do with supply side policies, and are largely to do with a matter that Congress has to deal with, not the Fed. That's my personal view. Okay, I'm going to go through some of the issues that have been mentioned before, just to give you an idea, and I've stolen these charts from a speech by Stan Fisher recently, but you can look at GDP in up to 2005, and then since 2005, or since then up to most 2015. And the level of output has grown much slower than in the past, but a lot of that is due to a much lower labour input. Some of it is due to the population growing slower, some of it's due to a lower labour force participation rate. And that's part of that is demographics. So when we model what's happening to labour force participation rate, we can say the population is getting older, so inevitably the labour force participation rate would fall. So there's a demographic component, there's a cyclical component due to the fact we had the level of unemployment got up and people rose and people were discouraged and so on. And then there's a big residual component that we don't explain terribly well. But certainly demographics are pretty important there in terms of the growth and output and so on. So demographics might explain part of the fall in output going forward, the lower levels of output going forward. But then there's other things going on as well. So when we look at output in the business sector, you can see we've broken it down into what's happened to the labour input and labour productivity. So these two components here, the labour input and the labour productivity, they add up to the growth in output. And you can see the big difference between the earlier period, this good period here, and the most recent period. So some of it is due to capital deepening. The level of capital deepening that we measured here, it's reduced by 1/3. The contribution of capital deepening is reduced by 1/3. But the big change here is in total factor productivity. So the sort of dynamism of the economy, the efficiency which inputs are put together. So if we believe this story, there's not much we can do about demographics unless we reform migration policy in the US. So you could say migration policy in the US is a little bit too family orientated, maybe it should be more skill orientated, but that's a political issue. Demographics I see as being largely outside anyone's control. TFP is total factor productivity. That's much more to do with supply side policies, not monetary policy. We may have the Fed may have a role here, partly in terms of capital deepening, but again, I don't think the role is terribly big, not in the long term. Okay, and then this is a little sort of interesting. What's our estimate, our widely quoted estimates of the normal real rate of interest? So if the economy were operating at full employment, well, if we believe these widely quoted estimates, the natural rate of interest would have been about, in real terms, about 3% in 2000. So in nominal terms, the Fed funds rate in the long term would have been about the 3% real rate plus 2% inflation, so 5%. Now the most recent estimates are the natural rate of interest is about 0.2%, 0.2%. So that the nominal Fed funds rate in the long term possibly should be about 2.2%. So this is, in terms of monetary policy, this is suggesting a big change in monetary policy, possibly going forward, unless these underlying trends change. Okay. So these are other estimates to show you the issue. All these estimates of long-term growth have all declined dramatically. These are blue chip, our sort of consensus forecasters. Likewise, the survey of professional forecasters, again, they decline. The CBO and the FOMC. And even the most recent, between the June and September meetings, they've reduced their estimate of long-term rate of growth of output considerably as well. Okay, there's lots of open issues. I won't go into them too much, but to do with the mechanics of normalization. We've got a very large balance sheet, and how do we reduce the balance sheet? There's lots of mechanical issues that were discussed at the Jackson Hole, so I probably skip over those. If people have questions, we can talk about them. Since this is Ireland and I work in housing, I thought I'd mention housing to some extent. So one of the strange things about Ireland is we've had repeated housing crises of different forms going back since the 60s. So there is a real problem with housing policy in Ireland. And the problem is very often housing policy is very pro-cyclical. And then a crisis comes along and there's immediate reaction to the crisis. There's very much a tendency to focus on short-term goals as opposed to long-term objectives. So housing policy is not tenure neutral, and the treatment of owner-occupied housing is very favourable, and that is an issue now, and it's been an issue in the past, and it's likely to be an issue going forward until something changes. Coming from a US perspective, if you'd look at the low level of foreclosures in Ireland, and you'd say that's really surprising. And then loan modifications, there have been some in Ireland, but again, they're pretty low. Whereas the US had a high level of foreclosures, and it had quite an extensive range of loan modifications. And I always wonder whether the low level of foreclosures and loan modifications in Ireland actually extended the crisis. And then if we'd used greater use of shared equity schemes, so the lenders would have taken a share in the equity of the house, everyone knew the house price in Dublin were going to recover, because that's what every model of housing would tell you. Eventually, house prices overshoot in boom times, and they undershoot in bust times. So if the lenders had used shared equity schemes, it would have helped the flow of loans to the economy. And I suspect that was a lost opportunity. And then we've got these new, I wasn't here for the first session, for all of the first session, I only heard the second part, so I didn't hear the discussion of LTV and loan to value and loan to income limits. They're very popular when it comes to regulated housing markets. And the idea is you internalize some of the negative externalities from large default rates associated with high LTV and LTI limits. Now, at the moment, my personal view is the probability of large defaults in the Irish economy at the moment is pretty close to, it's pretty minimal going for the next few years at least. In terms of loan to value and loan to incomes, in the longer term, they're reasonable enough, fairly sensible. No one's going to object to them. Central bankers will love them. No central banker is going to be fired for introducing loan to value and loan to income limits. And central bankers love them for another reason. The academic central bankers love them because they can write lots of papers about them. So I'm being a little cynical there, but for those reasons. But the devil is in the detail when it comes to Ireland, and I'm maybe speaking from a lack of knowledge. To me, the timing of the introduction of these limits is an issue when the Irish economy is recovering. There are issues, obviously, if we place limits, we probably see a transfer from older generations to younger generations as parents help their kids with putting up some of the money for down payments. That's probably a good thing. In terms of some of the other things, we're reducing we're putting pressure on prices. So we're holding prices will be a little bit lower, but rents I think are going up as a result. And we know rents are high anyway. So these loan to value and loan to income limits, in my view, probably are putting pressure on rents when we shouldn't be putting that much pressure on rents. The reason being that these loan to value and loan to income limits, at the moment, they're second best policies. They aren't the issue. The real underlying issue in terms of the housing market in Ireland is to do with infrastructure and finance. They're the things that should be addressed first. Loan to value and loan to income limits, in my view, they're good, but maybe the timing is wrong. And in the short term, they probably have some unintended consequences in terms of driving up rents. Okay, that's my view. Thank you.
I said we are running a bit over, but I think it was worth hearing all the papers. I'm going to allow 2 very quick questions, if there are. Okay. So the man at the very back. Okay, got that question? Anne-Marie?
Alan, I like your presentation about more of so I think you were able to tell us the lessons taken on that from your area, particularly bearing in mind the practice such as a very strong sovereign bank nexus and heritage. Fiscal integration, there's a lot of fiscal expansion
Okay, that's it. Okay, I'm going to allow the speakers 2 sentences each, because we're here all afternoon and these topics will come up again. Dave.
So there is some evidence that the the poor performance, particularly of the past 2 or 3 years, of capital expenditure in the United States is not so unusual if you take into account the pattern of corporate earnings. So under a usual sort of investment accelerator kind of just looking at it looks extraordinarily weak. But if you actually then throw in sort of the earnings side of the picture, or in particular forecasted earnings, it does not look so unusual. So I think there's pretty good evidence that what you suggest is part of that picture, which is quite apart from the whole productivity question, really, that Gordon's talking about.
All right. Wait.
I'll give you 1 sentence. Thanks, Anne-Marie. Question. I think that the main lesson is don't let deflation become entrenched in people's psychology. So act decisively to end it.
Anthony, do you want to add something?
Oh, just on Gordon's views, well, some of his views are contradicted by even accounts in his own book. A lot of new technology comes along, and it's 20 or 30 years before we actually see the benefits of it. So part of the low TF, total factor productivity, I think could easily turn around. So Gordon is very much all the low-hanging fruit of being exploited at this stage, but I think he's on the extreme.
Okay. Thank you very much. That was a great session. I enjoyed it.
Next up, by the way, before I introduce our next speaker, I want to welcome John Bruton, the former Taoiseach and European Union ambassador to the United States, who will be speaking after lunch. But our next speaker is going to be on the other side of the aisle from the central bankers, and that's John McCarthy, who is the chairman of ING Bank for Turkey, all the stands, Uzbekistan, Pakistan, etc. And John is also involved with the ING banking operation here in Ireland as well. So please welcome John McCarthy.
Former Taoiseach Bruton, good morning, ladies and gentlemen. I'd like to start by thanking the Global Interdependence Center for inviting me to this current central banking session here in Ireland. I particularly want to thank our convener, Bill McLaughlin, whom I've come to know through our work together on the Global Irish Network. As a dual citizen of both Ireland and the U.S., but living in Turkey, I'm always happy to come home. And right now I can say get out of Turkey for a while. I will speak to you today privately, again the disclaimer, not in my capacity as an ING representative, although I have drawn on our ING research and economic teams. My comments are mine and mine alone. We've just heard some excellent panelists, an excellent panel discussion, and I realize that I'm the only thing standing between you and your lunch. I'll try to be brief and to the point. Regarding that goal, I'm going to further acknowledge Bill McLaughlin by remembering, stealing that is, 2 points he makes for such speaking occasions. The first, which he claims is from his mother, is her advice: just because you don't make a good speech, it doesn't mean you can't make a short one. The second is his admonition: be careful when you give a mic to a Mick. My talk this morning is really of 2 parts and is offered from a banker's viewpoint. I'm going on 50 years in banking, and I think I'm a fairly seasoned practitioner at it. I'll first run through the European banking environment and then discuss the impact of negative interest rates on financial institutions. It's been touched on, but I may go into it a little bit more in detail from, as Bill says, the other side. I know we have many distinguished officials, regulators, economists, and academicians in the room. I think Daniel may have felt a little bit like this as he peered into the lion's den. Continuing in a disclosure mode, I must warn you that I am uncomfortable with using slides. I recently lost the sight in one eye, and my good eye is colorblind. so sorry about that. So we'll go into the slides. We all know how we got here, and I say we being all of us, but let's face it, the bankers in particular share the accountability on this. The aftermath, we've seen it, the bail-ins, the bailouts by taxpayers, shotgun marriages in the industry. We've seen bankruptcies, we've seen fines, financial losses, and increased regulation, all of which I think can be summed up from a banker's point of view. The basic commodity that we sell, trust, we lost. A central pillar of post-crisis financial regulatory reform has been higher capital requirements for banks and other financial institutions. While banks globally now have much more robust capital and liquidity positions, the Basel III framework is now being completed. The final revised calibration of capital charges on credit, market, and operational risks may further increase capital requirements. Furthermore, minimum liquidity coverage ratios, net stable funding ratios, leverage ratios, and the measure of total loss absorbing capacity put additional demands on top of the Basel III capital requirements. The industry, the participants, consider that this new push, beyond the broadly justified increases already achieved, could go too far, leading to a shrinkage of bank balance sheets, including through a reduction in lending to businesses and consumers. Behind the idea of increasing bank capital requirements is a view that raising bank capital will reduce leverage and thus risk, specifically the probability and severity of a financial crisis beyond this. However, there is much less consensus on the extent of the trade-off, at some level, between higher capital and less risks for banks versus their ability to raise capital to fund that lending into the economy. Many practitioners believe that increases in regulatory capital requirements might do more to burden lending than to increase bank resilience. On the chart, we see that despite a significant increase in core Tier 1 capital, the cost of equity has risen noticeably in Europe and the US. The same applies, by the way, for Japan. Particularly important in explaining the rise in bank cost of equity has been the sharp decline in bank profitability, as reflected in the drop in ROE from around 15% to 8% for U.S. banks and around 4% for European banks. This poor profitability, coupled with earnings uncertainty, has greatly depressed bank valuations. Price-to-book ratios have fallen to below 1 times. Across the board, pushing up the cost of equity. There is also evidence that investors will not accept utility-like returns from banks given their central role in the economy, which implies an inherent cyclicality and volatility in earnings anyway. The result of all of this is that increasing capital and related requirements beyond some point, which many participants believe has already been reached, will do more to reduce the volume and increase the cost of lending than to increase stability in the system. The euro area financial institutions continue to make steady progress in building up resilience, though still face challenges relating to weak growth, legacy issues in the form of NPLs, and regulatory changes. I think the fact that the red section is just about eliminated indicates that the banks have got the message, the system is well capitalized at this point, and the green sector, I believe it's the green sector, is growing. Growth has resumed in total loans for the euro area, although at a slow pace. This is particularly important for SMEs, which are heavily dependent on bank financing. The line, however, is not very exciting. I think, as I listened to Shannon this morning, I got a more optimistic picture than what we actually in the field are seeing. Growth has resumed in total. These are actually the business loans. I've switched these two headings. This is actually, growth has resumed in total business loans for the euro area, although at a very slow pace. We're just really back to 2011 levels in business lending, although the trend, admittedly, is up. The shares in household and non-financial business debt financing. Here, in the bottom line, you've got the U.S. As was mentioned, banks are more crucial in the EU as opposed to the U.S., where greater access of the capital markets is used in the form of bonds, etc. The gray area is other financing, and a great deal of that is credit card debt. If we look up at the EA, the European area, EZ, the Eurozone, you can see the effect of bank financing there vis-a-vis the bond market. So banking is very important for the EU, therefore the regulatory aspects which impact banking are critical for the EU. A key challenge for the European banks is linked to the prolonged period of low profitability. While bank profitability has recovered somewhat, it's still very low. The euro area banks are at, as I said, around 4% return on equity, and for the European area banks who are listed on their various exchanges, we can see the cost of capital is significantly higher than their return. There's a large stock of legacy non-performing loans in some countries, and this continues to dampen the profitability and weighs on the bank's capacity to extend new loans. Unfortunately, progress is slow in reducing the NPLs, which you can see on the left-hand side. The trend of the various columns is in the right direction, but it's moving with glacial speed, reinforced, I think, on the right. One of the structural impediments to profitability recovery is related to overcapacity concentration in some parts of the EA. Market concentration has been increasing since the pre-crisis period. On the left side, in particular, what I refer to as the Herfindahl Hermann Index, which measures concentration, indicates clearly that the trend really towards bigger and more concentrated lending institutions is apparent. It's broken down by country on the right. This would then lead you to think about consolidation. But in the European area, the trend in mergers and acquisitions has remained broadly unchanged since 2013. We are seeing ongoing consolidation, but it's very, very slow, and it's been on a decreasing trend recently. If you look at the number of deals on the left, going down, and obviously the value of what deals are being done, going down. This is from Ernst & Young. They do a survey called the Banking Barometer. This is recent data. It indicates that despite a renewed focus on efficiency, risk management and regulatory compliance will continue to lead the banking agenda. Increased emphasis on the efficiency agenda is expected in 2016. Streamlining processes remains the most important cost reduction initiative, but 51% of respondents now see minimizing non-essential spending as critical, compared with just 37% in 2015. There is also greater focus on parts of the growth agenda, with investing in customer-facing technology a key priority for 53% of respondents, compared with just 43% in 2015. Another route to growth may be through partnerships with industry disruptors, and 23% of respondents expect partnering with tech firms to be an important factor for their institutions. Nevertheless, risk and regulatory compliance will continue to dominate the banking agenda, and the results of the 2016 EU-wide stress test means capital requirements will need to be a key focus for many institutions. Cybersecurity has also gained greater prominence for bankers across Europe, with 56% citing it as important, up from 48% last year. The money. Bankers anticipate ongoing, this is also from Ernst & Young, same barometer. Bankers anticipate ongoing moderation of pay, reflecting the impact of weak business performance, as well as regulatory and shareholder pressures. Although 22% of bankers still anticipate a rise in aggregate pay in 2016, the same number is in 2015, just 12% anticipate a rise greater than 2%, compared with 17% last year, while 60% of bankers expect aggregate pay to remain flat in 2016. This trend is likely to continue as institutions will face greater regulatory pressure when the EBA sets out its sound remuneration policies, which are expected to come into force by January 2017, introducing new rules limiting bonuses to a maximum of 2 times base salary. Pay must now be better aligned to both institutional and individual performance, as well as to risk. The downward pressure on pay may mean banks will need to find new approaches to recruiting and retaining staff in the future. Coming back to the threats also on banking, as we know it today, and changes that are necessary in the business models going forward, we think that both McKinsey and Accenture, and probably other consultants, have got it right. Roughly 35 to 40% of our business is vulnerable to attack by fintechs. Cabbage, which is the little company there, is a company in which ING has recently taken a major equity position in. I think a number of our competitors will be doing the same thing, are doing the same thing. It's not only defensive, it's good business. At ING, we're one of the world's largest internet banks. We were larger before the crisis. One of our goals is in the retail space is what we call the 5-minute loan. That on the net, we will have the capacity to roll out a 5-minute loan approval. We're trialing it in Romania with success. Turkey will be next. Turkey is an interesting market for retail products. It's Europe's biggest market, if you want to consider it within Europe. And it's a great laboratory for retail projects. It's a computer literate country. Internet usage is extremely high. Penetration is very high. So it's a great laboratory for something like what we do. Now, I would like to turn to negative interest rates and their impact on financial institutions. The impact of negative interest rates should be viewed in a broader context as the latest stage of a long-lasting regime of extraordinary monetary policy measures that has included cutting rates to below zero and adding a massive dose of central bank liquidity to the global economy via QE. A number of major central banks have set negative policy rates, pulling down other short-term money market rates, in the hopes of stimulating economic growth and restoring inflation to target levels. Bond yields, too, are negative in many countries, reflecting the interaction between central bank policies and market expectations of slow growth and inflation for some time to come. This leads to an overvalued bond market and an underappreciation of duration and political risks. Negative rates thus serve as a reflection of overall slow economic growth, pending the hoped-for success of monetary accommodation, and define a very difficult operating environment for market participants. In addition, central bank QE has locked away a significant volume of high-quality liquid assets, not just government, but also high-quality corporate bonds and mortgage-backed securities, at a time when such assets are in great demand due to regulatory requirements, precautionary preferences, and collateral needs. Altogether, government securities on the balance sheets of the Fed, the Bank of Japan, Bank of England, and the ECB total over $7.5 trillion. Some observers view this situation as a form of financial repression of financial institutions and savers, while reducing borrowing costs for governments. Moreover, the resulting shortage of such assets has caused strain and abnormal spread relationships in funding markets, which could interfere with the smooth functioning of capital markets themselves. Taken together, the implications of negative interest rates, while manageable on a practical and short-term basis, can be far-reaching, especially for long-term investors. The combined impact of weak growth, low and negative interest rates, and flat yield curves has led to a decline in the growth of lending assets, a compression in net interest margins, and ultimately a fall in the bank's return on assets. For example, the net interest margin of major UK banks has fallen from about 150 basis points in 2007 to below 90 basis points today, contributing to a decline naturally in their earnings. Although still relatively high compared to other regions, the net interest margin of US banks has also declined by some 70 basis points since 2010, and now hovers near a record low of 3%. As highlighted in a recent Federal Reserve research note, margin compression has been more pronounced for large US banks than small banks, in part reflecting a more significant decline in funding costs for the smaller banks and a sharper decline in the interest income of large banks. The Fed study found that NIMs in high interest rate environments were about 150 bips higher than when rates are low. Meanwhile, a combination of changes in the regulatory environment, in particular capital requirements, a reduction in risk appetite, and evolving business strategies have led to a noticeable reduction in the use of leverage by banks. Combined with the decline in ROA, they have reduced banks' return on equity across the world from somewhere in the teens before the financial crisis to around 5 to 9% now. In many cases, especially in Europe, banks have been unable to generate ROE sufficient to cover their costs of capital. As a result, bank valuations have been depressed compared to other market sectors, as I've already pointed out. Bank price-to-book ratios now generally trade near or below 1, notably for EU and Japanese banks. This low valuation heightens investor perception of solvency risk, pushing up the cost of equity and making it difficult for banks to raise newer capital. Overall, unprofitable and low-valued banks are eventually unsustainable and could become a risk to financial stability in addition to being unable to finance economic growth. However, without strong growth, room for strategic enhancement of bank business models, mainly diversifying away from reliance on NIM to develop fee-based revenues, appears limited. One particular avenue towards improving the health and profitability of the banking sector, i.e. consolidation, is crucial, especially in overbanked Europe. However, there are many obstacles to consolidation, including a political and regulatory bias against big institutions, as well as a lingering desire to protect national champions in some jurisdictions. While the preceding is broadly true across the banking sector, the direct impact of negative interest rates on banks varies greatly depending on legal, regulatory, and contractual arrangements in different jurisdictions. For example, in some countries, banks are able to pass on negative rates to their deposit customers directly, either legally or through contract, even though many banks may be unwilling to do so to preserve customer relationships. Instead, banks may try to raise fees for services or other lending rates to compensate. Many or most banks concede the need to pass on lower rates to stay competitive. This obviously puts pressure on the remaining banks, whether they're weak or strong. In some countries, such as Switzerland, short-term money market rates, as well as time deposit rates, have dipped into negative territory, but saving deposit rates have been constrained by the zero bound, as banks want to preserve their client relationships, as well, I would say, as avoiding public backlash against lowering interest rates on savings. However, due to strong demand for mortgage finance, Swiss banks have been able to keep mortgage rates basically unchanged, resisting the pull to lower rates. For similar reasons, mortgage rates have not changed much in Germany. However, such stickiness in lending rates weakens the aim of monetary easing to lower borrowing costs to customers. Hoping to kickstart European economies, the ECB took the extraordinary step 2 years ago of lowering one of its key interest rates to below zero. The idea was to discourage banks from stashing their money in the central bank by charging them a modest rate for doing so. Since the banks would then lose money rather than earn interest on their deposits, it was hoped that they would be prompted instead to make more loans at lower rates to businesses and consumers, lending to grow out of the recession. It hasn't worked very well. As many experts predicted at the time, the policy has had only a modest impact on growth. It's also increasingly clear that pushing rates down further wouldn't help much and could in fact increase risks to the global financial system. The European Central Bank sets monetary policy for the 19 countries that use the euro. In June 2014, it became the world's first major central bank to adopt so-called negative interest rates. Negative rates have helped to push down the cost of borrowing, but that has not provided a big lift to the euro area. The ECB expects growth of 1.6% this year, about the same as last year. This is not surprising, because lower rates don't address the real economic problems suffered by many European countries, namely weak consumer demand and weak business investment. Companies are less likely to borrow for new investments when demand for their goods and services is not increasing, even if the cost of borrowing is cheaper than ever. Rather than borrowing to invest in growth, as hoped by policymakers, companies have followed their own rational ideas. They can borrow to buy back stock or to finance dividend obligations to reward their investors. Companies can also borrow cheaply to finance acquisitions. Conditions are supportive for the companies to finance M&A through debt capital markets or bank loans. Companies may choose to borrow cheaply simply to refinance existing debt at lower current rates. There are even signs that some companies simply want cheaply held cash on their balance sheets in case the economy heads south. It would be far better if European governments used fiscal policy to increase demand by investing in roads, bridges, railroads, ports, and other infrastructure. We've heard that point this morning already. Mario Draghi, the president of the ECB, clearly understands the risks of negative interest rates, which is probably why he didn't lower rates further last month. But there is only so much he can do. We would do well to remember that banks are not the only financial service providers affected. Certainly, lower interest rates reduce the income banks can earn from holding safe assets, such as government bonds, whose yields are closely linked to official interest rates. This is, however, also having a major impact on insurers and pension funds, who tend to invest in such relatively low-risk, long-term assets. Across Europe, returns on investment portfolios have been falling. Have been falling. At one major French group, for example, the portfolio yield has fallen from 4% in 2010 to 3% in the first half of this year. Negative interest rates, especially as they now prevail on over $15 trillion worth of bonds across major world economies, may ultimately render the whole current concept of saving for retirement unworkable. This week's edition of The Economist carries a briefing on the fall of interest rates. It states, and I quote, "Central banks have rigged the money markets. They have been aided in this by new regulations written in the wake of the global financial crisis that require banks and insurance companies to keep more of their assets in safe and liquid instruments, such as governments. That is helpful to rich world governments with large debts who need to keep interest rates low. But it is punishing the thrifty and those who rely on bonds for their income." I'd like to conclude by saying the post-2008 work in progress will continue. Central banks, I think, have shot their wad. I think greater policy issues require active political engagement and fiscal measures. Thanks.
John, thank you very much. That was a really nice side to see that side of the question addressed today. Lunch is right next door, and we're going to pick up the same conversation this afternoon with former Taoiseach, John Bruton, and come back in, we'll move, if you look at your program, we'll just move it 10 minutes back. So we're due back at, what time we due back at? Okay, so we're going to start at 1:25. Lunch is right next door. And I think John McCarthy is willing to take any questions that you may have had for him at the table.